Welcome back to All Things Money. I'm David Blain, and during today's show we're talking about sectors and industries in the economy. If you'd like to listen to a replay of this show, please visit us on the web at www.dlblain.com. That's dlblain.com, where you'll hear a replay of this show as well as any other shows that you may have missed. Before the break, we were talking about the market as a whole, and one additional point on that I wanted to talk about is the correlation of individual stocks. At different times, different markets, either in the U.S., around the world, as well as individual stocks, either move more in tandem or more randomly. And what does this mean? Well, at times when all stocks are moving in tandem, meaning the U.S., Europe, Far East, energy companies, consumer discretionary companies, all types of companies generally moving in the same direction. What this means is that the market is the dominant factor at play, and there's not much additional return available by being very selective. It's times like this when you want to either own the market, or correlations can also become very high in times of economic stress. And currently, the correlation of all the 500 companies in the S&P 500 is around 0.8%. Now, that number may not mean a lot to you, but that is a very high correlation. It means that the major factor at play right now is the market, and that stock picking and industry picking are not quite as fruitful as they can be at other times, such as the market lows. Back in 2001, the correlation was down around 0.15. What that means is that during that period of time, it really did not pay to own the whole market because the market as a whole, there were individual companies that were doing much better than the market. Today, as we saw at the March 2009 bear market bottom, we see that most companies are moving together. Once again, not very good for singling out individual stocks or industries. So now we'll move on to materials and energy. As I just said, with the correlations rising, materials and energy are no exception, and the market continues to be the dominant factor in play. We got a little bit of information from Ned Davis Research here on sector performance during 5% rallies since the March low of 2009. And so what we're trying to do here is give you some information of when the market rallies, which we think it is right now and will continue for a little bit, is what sectors may benefit from this. Since the low of March of 2009, energy and materials have averaged about a 34% gain every time the market rallied more than 5%. 100% of the time, they outperform the market as a whole. So what does all this mean? It means that the energy and materials sector, if the market rallies, and the past year is any indication, should outperform the rest of the market. So when you're looking at where to put your funds, if the market should rally on into the summer, we think that energy and materials are well positioned to benefit. However, consumer discretionary, financials, and industrials also have been very good performers in the high 20 to more than 30%, and they've outperformed the market about 80% of the time. Consumer staples, telecom, and utilities have outperformed the market none of the time that the market has rallied. Once again, going back to the shut index, or our defensive index, is that these type of industries and sectors are not typically where you want to be when the market is rallying. Some sub-industries that have done very well, that the opposite occurs. If the market does not rally, these industries typically go down the most. And we see things like steel, metals and mining, paper and forest products. These type of industries certainly will go up significantly if the market rallies, but also have a tendency to go down a fair amount if the market does not rally. We're going to look at the commodity market now. Commodities continue their upward trend. Gold mining, metals and mining, steel, these types of industries, coal, oil and gas, these sub-industries are well positioned to take advantage of the commodity factor. Another interesting trend is the commodity market, the impact of the dollar on pricing. If you look at the value of the daily dollar returns of the commodity index, there's almost a perfect negative correlation between the dollar and the commodities index. And what do we mean by this? Is that since about 2006, the dollar index and the commodity index have been almost a perfect mirror image of each other, meaning that if the dollar is appreciating, commodities are going down. If commodities are increasing, then the dollar is going down. And so what this means is that the most sensitive, you need to make sure you understand how sensitive what you're investing is to the dollar. So for example, gold mining, coal, those type of sub-industries are very sensitive to the dollar, and so it helps to have a view on the dollar and what the dollar is doing as well. China's relative strength has been leading moves into commodities and commodity related stocks as well. Before we get into the break, I wanted to take one last look at gold, and we see that gold's rise in terms of the major currencies in the world. It's continuing to rise against the U.S. dollar, the yen, the euro, the British pound, and the Swiss franc. And we think that this is essentially a risk trade, that people are fearful of what may be going on with the fiat currencies or paper money, and so they're moving into gold. Well, that brings us to our next break. When we come back, we'll wrap some of this up and take a look at some of our viewers and listeners' questions.